Welcome to the Debit This, Credit That podcast with Wheeler Accountants located in San Jose, California. In this podcast, we discuss how to solve accounting challenges in both your personal life and your business. We take an energetic, tech-savvy approach to solving accounting challenges that steal your focus and your time. Now, on to the show with your tech-savvy accounting experts, Matt Wheeler and Michael Bryant.
Welcome to episode 30 of the Debit This, Credit That podcast by Wheeler Accountants with your hosts Matt Wheeler and Michael Bryant. Actually, today just going to be me, Matt Wheeler, so Michael is not available to make it for our podcast. But I do have one of our other partners on today, who's our guest today, Jen Hauck. She's been with our firm since 2002, I guess, so longer than me.
Time.
And before that, you were with Keith Plattel, who was our former managing partner before myself.
That's correct.
And the Keith firm merged in 2002. And you were with Keith for how long before then?
I started with Keith in 1989. Yeah, for 3 years.
You were experienced.
I guess so, yeah.
So Jen specializes in individual income taxation, and she also does a lot of the estate and gift tax work here at our firm, as well as she's the HR partner in the firm, handling a lot of the administrative duties for us there. So she's a huge part of our team. Very happy to have her on the podcast. And today we're going to talk a little bit about her practice, kind of what drives her, and then we'll go over some of the basic estate and gift tax issues that our clients see, maybe some things about aging parents and how you deal with those situations, which is something you handle quite often.
Yes.
How our firm can assist in the process when you do have the death of a loved one. Then wrap it up. Sound good?
Sounds good.
All right. So I got to ask you first.
Okay.
You've been doing this for a long time. You must be doing it for a reason. What do you enjoy most about the job? What drives you? What's your passion?
Working with individuals, working with the people. I've always liked numbers. They kind of come naturally to me, but if you told me I had to just work with numbers, I probably wouldn't continue to do just this. It's working with the individuals and talking with the clients and getting to know them, developing a rapport. To me, and helping them, to me, that's what I'm passionate about. That's what drives me.
Just like the opposite of what you expect in an accountant.
Yeah.
The stereotypical accountant who's just like focused on the numbers and very dry and everything else. But you spend a lot of time meeting with clients, especially during tax season, outside of season now, on all kinds of consultative issues surrounding individual income tax,
right,
state and gift tax, everything else. And you are also a part-time unofficial therapist.
Kind of comes with its territory, and I don't mind it, because what happens when people are talking about their finances, or they're talking about the decisions that they're making, especially with estate and trust and who they're going to give their money to and why, you want to know those things, because those philosophies, those things are what are important to them, and they help you do the job that you need to do for them, because you can kind of help get in their mindset. You understand where they're coming from, and then it just builds that relationship. And they learn about my family. They kind of get my, where I come from. So it's definitely mutually beneficial, I think, for everybody. It's, we're very much in the position similar to, I would say, any advisor, doctor, dentist, those types of people that you see, you tend to stay with. They tend to stay with their accountants for the most part, So have a history that you develop, and you see these people grow over time. So it's exciting.
I take it that a lot of the decisions you're helping them through aren't necessarily financial specifically or tax related.
Yes. I mean, the nice part about it is, I've had my own life experiences. I have the experiences that, clients share with me. Obviously, I don't get into specifics with other clients about other situations, but I can garner their experience and I can learn from it, and maybe that is applicable to somebody else. So it's easy to kind of gauge what they're looking for, and a lot of times it's not just tax related. Tax is one aspect that we're looking at versus a million other things and reasons why they do what they do.
You're just giving them the breakdown on their options,
right,
kind of the consequences of each choice, and then helping them guide them through those choices.
Right. And if I'm not the right professional, I can, obviously tax is, our area of expertise, or at least my area of expertise. If I'm not the right professional, at least I can help them find who they need to get the right guidance.
Well, let's talk a little bit about just the overall estate and gift tax process, mostly the estate tax process we're talking about here. For the benefit of our clients and listeners who may not know as much about it, there's a lot of confusion surrounding estate and gift tax.
Sure.
And, when are estates taxable and when are things subject to income tax or estate tax or both. For the typical clients, we encourage them to get a living trust, right?
Yes,
Or revocable
absolutely.
living trust. Can you give us kind of a rundown on what the living trust does for them?
Well, one of the primary things that it does for them is, when someone passes away, if they don't have a trust in place, they may have a will, but a will does not keep them out of probate. That's one thing, which probate has statutory fees. It can be very costly. Then they also are giving the courts the ability to dictate who gets what. The courts will, of course, acknowledge a will if there is a will, but if there's somebody who's not mentioned in the will, but yet they might have a right to some assets, a cousin that lives in another country that they've never seen, but they might have a right, the court has to do those considerations. And so it's definitely better if you have a trust set up. There's, creditors, those types of things. People set those things up for, different reasons, credit protection. The other thing that they do is the reason why they set up for trust is family situations are complicated. Sometimes there are situations where you just don't want someone to inherit at a certain age. Maybe it's a child who, has struggled growing up. And that this child, it's not that you don't want to give them their portion of their inheritance, but that they're going to need some help. And so you want to set up an extra trust for them, and you want somebody else to watch it, and they get their money in maybe lump sums or at a certain age. So there's a whole lot of different reasons why people put trust together. And there's no guessing. It helps the person who has survived you to deal with those things, because not only are they going through the emotional, the grieving, or whatever the process is at that time, they're not guessing as to what you wanted. So
Right.
It's important.
So the probate process is a legal framework that's been put in place that serves as the ultimate backstop. If you don't do anything planning for your death, then we have laws that dictate exactly what will happen to your assets, and everything will be taken care of. But that has to go through a court process.
That's correct.
There's mandatory statutory fees based on the value of the estate that are charged both to the attorney handling it as well as to the executor. And then
The state rules are governed by state, so it's not a federal thing, it's a state thing. So each state has their own process and their own rules.
that's a good point. And it can get very complicated if there's multi-state issues involved.
Correct.
And it really just serve as the backstop in case you haven't done anything. But you don't have control over what happens to your assets when you pass in that scenario. It could be unintended consequences down the road at the time of your passing if some of the relatives you wanted money to go to are now deceased, and other ones that you can't stand are
Right.
the
Yes.
ones that are still
It
alive.
happens, and,
Yeah.
unfortunately.
So that's definitely part of it. What about on the estate tax side? What does the living trust do for you?
Well, so let me kind of clarify that just a little bit. Sometimes one of the bigger issues that I have is people don't understand estate tax versus income tax. There's two different types of systems that we're talking about, right? So a lot of times there's the misimpression or people hear, oh, well, there's an inheritance tax. And then there's well, I'm not going to get taxed on that because I inherited. So there's all kinds of different views on what's really going to transpire. The trust is going to, if you have a trust set up and somebody passes away, when things are put in trust, the assets, the titles, all of those things are changed. It shows your intent, right? What happens when somebody dies is you look at someone's estate. And basically that is all their assets that they own or have control of or a majority interest in. And so a trust helps you dictate what belongs in the estate, basically, and helps you put the estate tax return together. It's sort of like a balance sheet, basically, of somebody's assets and what they're worth at that time. So depending on what that dollar amount is whether you need to file the estate tax return or it's not a taxable estate. And then there's the
and
trust.
what's the dollar amount now?
It's a little over 11 million. I don't know the exact amount, but it's per individual. So, a little over 22 million for married filing joint couples. So it's pretty high.
Gone up quite a bit with
Yeah.
the new law that just came out.
That's correct. But that law is as permanent gets in our
Right.
government. So things could change, depending on who decides, who's in office, who decides what. So those don't always, 10 years ago, 8 years ago, there was no estate tax for 1 year. And then before that, it was $1 million. After that, it went to, an index. So it changes all the time.
Yeah. And so the trust helps kind of corral all the assets together.
That's correct.
You get the balance sheet, the snapshot at the point in time at your death, and you see how much the value of the total estate is. If you're over the threshold, you're going to owe estate tax. If you're under the threshold, you're not going to owe estate tax.
That's correct.
And then how does income tax play into everything?
So income tax, so the assets, as long as they're sitting in the trust until they get distributed out to the respective beneficiaries, they're going to sit in this trust. If they're income producing assets, there's going to be tax required, just like as if you had your own, if they were, your own individually. You have a piece of rental property, for example. You're going to pay tax on that if there's income. That's income to you. It's the same thing with a trust. It's just kind of a separate entity from the individuals until they get distributed to their respective beneficiaries. So a tax return would be required, and the minimums are very low for a tax return. Gross receipts of $100 for a trust, gross receipts of $600 for an estate. So very easy, especially in our area, to get to those minimums. So there's going to be an income tax requirement for filing the income that's produced from those properties. Now, you get to write off the expenses and the deductions, just like you would with an individual, but you still have to file a separate return. And then once everything's passed out, then it gets put on the individual's tax return going forward.
Does a trust help with income tax before you pass away?
Well, it's considered disregarded, assuming that it is a revocable trust. If it's irrevocable, then it's going to have to file its own tax return, because irrevocable, majority of the time, you can't make any changes. The only way that a change could be made is if somebody petitioned the court generally. But a revocable trust, the IRS considers that disregarded because you can make changes, you can change beneficiaries, and so all of the income gets passed through to you anyways. It's on your individual tax return, so there's no differentiation, but it does help in regards to making sure things are titled properly and having the trust set up. It's not for income tax reasons, but for reasons of title, reasons for following the trust when somebody passes away. If you have things set up properly, it just makes it that much easier. It shows your intent and what you were planning to do.
Yeah, so there's all sorts of non-tax reasons why
correct.
you want the living trust and why we recommend it for the majority of our clients.
Right.
Helps with the division of assets according to how you want it to go. Helps with estate tax a little bit.
Mm-hmm. That's true.
Where it carves out some of the assets on the first spouse's death, so they're not subject to estate tax on the second death. That's the way you want to do it.
Yeah, if it's written in the trust document, a lot of the trust documents will have what they call an A and B setup, where they can split out, or and there might even be, a Q-tip in there, but where they split their assets depending on the size of the estate. A lot of times right now, because the exclusion is so high, those A and B setups aren't necessary. But you definitely want to have that language just in case. It should be an optional thing. There should be things in the trust written that gives the trustee discretionary on those types of things, because the laws change.
What's an A trust and what's a B trust?
So an A trust, and this is going to sound a little morbid, I guess, but an A trust is kind of, and this is the way it's easy to remember, is for the survivor. It's kind of the above ground, the person who's above ground. The B trust is for the bypass, is generally set up for the person or the assets that are for the person that has passed away, so they're below ground. So that's kind of an awful way to remember, but that's the way it's set up. And so it was very common when the exclusion levels were really low, because it's very easy, especially in our area when it was at $1 million, to hit $1 million estate. Now that the estate exclusions are much higher, there may not necessarily be a need, although that's just for income tax. There are other reasons, non-tax reasons, why you may still want to go with an A and B setup, because it could be a second marriage, there could be different beneficiaries, all kinds of different reasons.
So the B trust, for the person that passes away, it's their share of the assets that gets put aside into this separate, now irrevocable D trust.
That's correct.
And what's also irrevocable is the beneficiaries of that trust. Typically,
yes.
We're going to just choose like a standard example family would be the kids of, the first husband and wife couple, their kids, the B trust is going to be set aside irrevocable for the benefit of those children. And then if the surviving spouse then later remarries, those assets are still carved away and set aside for the original group of children from the first marriage.
That's
right?
correct. That's correct. It's for their protection, basically.
Yeah.
Mm-hmm.
And the way I advise a lot of my clients often is it's not about trusting or not trusting your spouse. It's just about unintended consequences later. And I use the example of if you don't carve the assets away and it all goes to the surviving spouse, and then that spouse remarries, and then your spouse passes away also, and now this new spouse that came into the marriage later that didn't know you at all or your children could then have all the power to disinherit if the estate and trust isn't set up properly.
That's
and your
correct.
kids will then be left with nothing. So by carving aside the assets in the B trust and the bypass trust, you're at least guaranteeing that of your half of the money or whatever percentage of the money is yours, that's going to be going to your children and taking care of them. And then your surviving spouse can decide what they want to do with their portion. Hopefully they're also setting up a new trust with their new spouse and they're setting it
That's
aside
correct.
for your existing children also, or maybe a combination of existing children and new children from the new marriage. But at least you're protecting your children in your B trust.
That's
when
correct.
you pass away.
Yes.
These are terrible things to think about, but they have to be thought about because these
You just
nightmares
never
can
know.
unfold, and
Absolutely.
we've seen them happen.
Yes. And
These worst case scenarios. Let's talk a little bit about, you get the trust set up, fantastic. You
Right.
went to the estate attorney, you signed everything, they transferred your house title into the trust, but you're not done yet.
Mhm.
What else do you need to do at that point to make sure your trust is really operating properly?
Well, you definitely, obviously changing title, making sure your beneficiaries, even for assets that are not necessarily in the trust, for example, your IRAs, anything that's kind of in a third-party administrator, it's being run by a third-party administrator where you can designate a beneficiary. You need to make sure those are up to date. You have to, make sure that a lot of times you're going to have to make sure that you've got the right trustee, you have a backup, that you have, that there's individuals that can help you or help the trustee to, put your, get everything ready when, if and when when you pass away. There's all kinds of different things. One of our things that we do too is you definitely want to contact us as well as your advisor. We can help. We're not attorneys, so we don't draft legal documents, but we can help with some of the decision making on what goes where, and helping your trust set up, what proper language, what's things to be considered, what rights you should have, because it is important from an income tax perspective to make sure that you have proper language to designate things like what is income to the trust, what is not income, what's considered principal, those types of things. And then we also, as part of our services, we like to get copies of the trusts and the wills once they're done, because we keep those as a permanent record. Because a lot of times when somebody passes away, the first people they call is that person's accountant or their attorney. But a lot of times it's us, because they know that there's some sort of tax requirement, but they just don't know what to do. And by us having those items and having been working with the client and familiar, we can advise, properly and help them, make it a little bit more smoother transition, because it's never an easy process.
Sure. And we'll get into some of our process on how we help in a minute. I want to go backwards a second here. And on the titling of the accounts, I think that can often be an overlooked thing with
Sure.
clients, where you need to go to all of your banks and brokerages and everything and retitle. Each bank or brokerage is like a different form or different method on what they need to see to title the account properly. But it's important.
It is important. The only thing that you have to consider and what, you got to be careful is broad saying all accounts. Yes, all accounts that you intend to be in the trust. You may have separate property. You may have things that you don't want in the trust. It's just important to have your accounts titled properly so that your intent is known. Because what happens is, if for some reason you pass away and you intended to have that asset in the trust and it's not titled properly, a lot of times attorneys are willing to go to the courts and petition the courts to say this was intended or those kinds of things, but you're taking a chance. It's a risk.
And in terms of like the estate and income tax consequences, when you pass away, most of your assets have like a reset to the current value for the income tax because they've been subject to the estate tax. Whether you actually paid estate tax or not is, in part irrelevant. It's that they've been subject, so they have a reset for income tax. But if you don't have the proper titling on some of those accounts, you may jeopardize a portion of the income tax step up. For example, if you have an account, a brokerage account with a lot of securities in it, and it's titled under like a joint tenancy and not in your trust, that would actually only get a half step up on the assets in the account for the half for the decedent, not the full step up as community property being inside your trust. And that could be, we're talking a significant thing. If you have $1 million of unrealized gain in there, you're only going to get $500,000 of step up. 500, you're not going to get a step up on. 500 times the capital gains tax rate, you're talking about a $150,000 mistake by not titling it properly.
That's correct.
In that circumstance.
That's correct. Absolutely.
That could have easily been avoided. So, yeah, it's not something to take lightly, and I think the attorney will draft the documents again. They'll transfer usually like one piece of property as part of the fee agreement with them, or they'll do more like for additional fees, but they won't go to the banks and brokerages and retitle all your accounts for you. You need to do that.
Yes.
And sometimes if the accounts are really small, it's almost easier to just shut it down, open a new one in the trust rather than retitle it because it can be kind of a pain.
Right.
It's also a good time to consider consolidating. Right?
Very true.
Maybe if you have
simplicity,
money all over the place, it's just too much to manage. So some things to consider. So speaking of that, aging parents, or you're starting to age yourself, kind of preparing to line up all your financial affairs, what are some of the things that you would advise clients to do as they're approaching that stage of their life, or as their parents are approaching that stage of their life, to help with the process later on? So
simplicity is one, right? You obviously don't always want to have your eggs all in one basket, but at the same time, you don't, the 22 different accounts may not necessarily be necessary anymore. Maybe we need to start consolidating, making it easier for whoever is going to be your trustee. Documentation, having your assets listed, and we have things that we can help you and give you. Having that stuff listed all in one area can help with the trustee, because one of the things that I find most often is, usually in a parent-child situation, let's say, a parent dies and one of the children is coming in to help the surviving spouse, or is, the trustee now. They have a real big issue because people don't always get involved with their parents' finances. It's kind of, I don't want to say taboo, but, it doesn't usually work that way. And so when they're trying to gather all their information, they don't know what mom and dad had. And so if you can start gathering that stuff and kind of get it all put in one place, at least, you're helping them out, basically. Have your trust updated, every couple of years. Laws change. Beneficiaries might change. Trustees might change. A lot of times people make trustees of people that are friends that are their age. Well, unfortunately, that person passed away before you did, and so now you're in a quandary. So those are the types of things I would also say, especially in this day and age with technology, passwords, having passwords to your online banking, those types of things. I know it's scary with the way, identity theft and all of those things. There's software out there, there's apps out there and stuff that you can do a locking of your passwords, got kind of a master password, and it keeps all of your passwords. But having those things accessible and letting the person know who's going to run your estate after you pass away, have that is really, really important. And this all boils down to helping the executor do their job, which is a substantial job. And I mean, how many times have you had clients come in and talk about they had no idea how much work it was going to be being the executor or trustee on like a parent's estate. And when you have 20 different bank accounts, you're going to spend several days just going to every single bank and having to talk to each one about moving the assets. And those banks by law can't just let you do whatever you want with the money. No.
If the account's not titled properly, you got to show that it was supposed to be in the trust. Or if it isn't the trust, you got to show that the trustee is dead. You're not a successor trustee. So that's why having everything titled properly makes it just so much easier from a practical standpoint for the executor. It does. And even when things are titled properly, if you have so many different bank accounts, each institution has their own paperwork. So you're filling out paperwork and you're going to have to supply,
generally the death certificate, the trust that says something that certifies that you are the executor or the trustee. There's just a lot of paperwork involved, even if things are titled properly. So if you have so many accounts, that can be difficult. I know the strategy was, and this was, kind of done for many years, is, people had different, they don't want to put all their eggs in one basket. I get that. But, people put money because they were planning on living off the interest and dividends along with, their Social Security, and that was part of their retirement planning. Unfortunately, with the way the interest rates are and things are now, that's not really as much of a planning vehicle, but it was for many years. Mm-hmm. And those are the people that are passing away now. So, are getting to the age where they're going to pass away. So consolidating is huge.
Another key reason to consider involving your, grown children in your financial affairs before you start getting too old is, the possibility of dementia later in life or some sort of
Absolutely.
Memory loss and elder abuse.
Mm-hmm.
And if you have full-time caregivers and you don't have someone else that has authority over your affairs, legal authority through a power of attorney or something, before you potentially get to that point, which is a possibility you need to plan for, can have pretty disastrous consequences.
Absolutely. So, we're, everything that we've referenced so far has been when somebody passes away, but absolutely, unfortunately, dementia, Alzheimer's, those things happen, right? And what do you do in those instances? How do you help mom or dad, or how do you help that person? And so making sure that those things are set up properly beforehand is important. The other reason that it's important, too, is because of family dynamics. When you might have a situation where mom and dad have decided to give one child more than the other, or, for whatever reason, something is unequitable in maybe somebody's eyes, right? It's better to have those discussions while mom and dad are still alive rather than leaving whoever is the executor to have to deal with it, because that's when litigation and lawsuits and those kinds of things happen.
Yeah, documentation is so important, right?
Mm-hmm.
You have one sibling who borrowed money from mom and dad because they were in a financial bind at one point, and then they say, oh, they told me that they were just going to forgive it and I don't owe it back, but there's nothing written. Just creates a mess, right? So you need to be really careful and document those things. And my advice always to clients is treat it like you would treat a business transaction. That's
Absolutely.
the most fair and open way to do it. Document it, get it in writing, and then that way the executor has something to follow, and it's according to your intent and fair. You can still give one child more than the others if you want. That's completely acceptable, but you should document your wishes so there's no ambiguity later on after you pass and you're not there to defend your decision or explain it.
That's correct. And because we've talked about how much paperwork is involved, it's not easy to close an estate. And so what happens is the process can be a long process. It's not uncommon for it to be 1 to 2 years. But when you have beneficiaries who are either unknown or have no clue what's going on or haven't been involved or don't know any of the decision making, that's when the unknown, what's going on, and that kind of it makes it difficult for the executor. They may not be doing anything wrong whatsoever, but if the beneficiaries don't have the information, they start to question what's happening.
So you're kind of getting into one of my questions coming up here. When do you consider doing something like a trust accounting? And what is the trust accounting?
So trust accounting is basically, most trusts in their in the language says that the trustee or the executor is responsible for keeping track of the income and expenses of the estate or the trust. A trust accounting can be formal. It can be formal, meaning that it's going to be required to go to the courts. It can be informal, such as just keeping a spreadsheet. It can be us doing bookkeeping, or somebody doing bookkeeping of the trust and estate. But the reason why it's necessary, there's a couple of different reasons why it's necessary. One is you're going to need this information for preparing the income tax return. You don't want to miss out on deductions. You don't want to miss out on expenses. A lot of people don't usually know what is the expense or what isn't. Two, you have beneficiaries that you have a fiduciary responsibility for. You need to be able to account for the funds and where they came from and where they went. And when you have different beneficiaries, when you have a situation where, unfortunately, it happens in the best of families. But sometimes when mom or dad passes away, if there was any dysfunction in the family, it's like tenfold once somebody passes away. If there was no trust between the siblings, a lot of times that trust is exemplified, when somebody passes away. So having an accounting, whether it's done, formally or informally by us or just the trustee, is important because the beneficiary has the right and can ask for that information. And so the trustee or the executor has to provide it. So it's necessary. And so we do those in our office. A lot of times we will, get in a situation where a client will hire us because, they're the trustee and maybe they have siblings that, it's not going so well. They don't have great relationships, so they don't talk, and the sibling is wanting a formal accounting. And so we have done those. We do many of those. And basically it's just, there's specific format for the formal accounting that it has to be provided. There's a specific format, but sometimes people will waive the formal and then just get bookkeeping reports, maybe out of QuickBooks, those kinds of things. But it's definitely necessary, just, not only for preparing a tax return, but it's also necessary a lot of times because the trust dictates it or a beneficiary has asked for the information.
Right. But at minimum, for a lot of our clients, we recommend they set up a QuickBooks online account or something that it links to the estate bank account. And that way you're automatically getting all the activity from the account, income and expenses. You're coding it. There's double entry accounting, so we know the accounting is solid and we're not missing anything so we can reconcile. And then that helps us prepare an accurate income tax return, much better than relying on the client's spreadsheet or their kind of one-sided method of doing accounting that may be missing out on potential items, income or expense, which could cause problems later.
Right.
And it generates reports that are useful to give to the other beneficiaries if they ask in an informal manner.
That's correct.
But if you have a situation where there's going to be a problem, or you have one particularly, litigious sibling or something along those lines, there's a problem, maybe then you step up to a formal accounting where there's a little more assurance there and they're able to feel a little more confident with the numbers, the beneficiary.
Right.
Good. Anything else on aging parents, kind of end of life planning from a financial perspective? People often ask me, about gifting at that point.
Sure. Yeah, so gifting is a good vehicle to move assets out of your estate. And it's, depending on the size of your estate, it can be some really good planning. A lot of times you want to gift something to your children or to your beneficiary prior to your death so that it's not included in your estate when you pass away, and they have access to it now. They have whatever, maybe it's a piece of rental property and you decide you want to give that to your, son or daughter or something like that. They'll have access to the income now rather than having to wait. Gifting is important. There are definitely reasons why you want to gift from a non-tax perspective, but then there's also from a tax perspective. It's not as big of a vehicle currently. Well, I shouldn't say that. Because the exclusions are so high, the $11 million per person, a lot of individuals actually probably won't have taxable estates. And so by gifting away, an asset before you die, that asset is not eligible now for a step up or possibly sit down, but an adjustment in basis because it's no longer yours.
Yeah. So there's a income tax trade-off.
There's an income tax trade-off. That's exactly right. A gift tax is a different type of tax, right? Individuals can give $14,000 away to
it's 15 now.
It's 15 and 18. Yeah. Can give that away to anyone, every year if they want to. That amount kind of goes up a little bit with inflation, and they don't have to file what we call a gift tax return. Once they exceed that $15,000 amount to that particular individual, then they would have a gift tax filing requirement. They can choose to pay the gift tax if they wanted to, but a lot of times people use their gift exclusion. It's an informational return, but the government does require you to file this form that says, hey, to let them know I gave this to X person. Now, if you're a married filing joint couple, you can each give $15,000 to a single person and not hit the filing requirement, assuming it's community property.
Yeah. So the gift thing, you need to really think hard about it because there's an income tax trade-off. The time I usually look at gifting with my clients in like a substantial or material amount is when they're going to be over the estate tax limit because then you're trying to get assets out of the estate. If they're under, it's a harder decision. You're thinking about the income tax trade-off versus probably the non-tax reason you're considering doing the gift. And you can't just give away all your assets right before death because they get added back into your estate. That's the point of the gift tax return. Otherwise, everyone would gift away everything before they on the deathbed. So a lot to think about in gifts. Don't go rushing into doing a gift without first consulting with us first, because there can be large income tax trade-offs. It's usually better to inherit a property that has a low income tax basis, because then you're going to get a high tax basis when it's inherited, versus a gift. It's a carryover basis, so you're going to take over the donor's income tax basis, which may be really low.
Right.
And so you have that huge built-in gain that you're going to have a tax consequence on at some point, income tax. By doing the gift, it's better to wait and inherit. But sometimes people just want to.
Sure. There's, like I said, there's non-tax reasons and other reasons why people want to gift.
One tax strategy I talk about with some of my clients that have aging parents, especially if they're in full-time care and the medical expenses are really high, is about doing Roth conversion or distributing pre-tax retirement assets like IRAs or 401ks to help pay for those expenses, because those are some of the few assets where there's both an estate and an income tax consequence to the beneficiaries, because no one's paid income tax on that money yet so far.
True. You definitely, if you have those expenses and you're going to have almost zero tax because your medical, their home care expenses, those kinds of things. Yeah, you might as well pull the money out so that you're paying zero tax, basically, right? And converting, then leaving it there. And like you said, it is subject to both income tax and estate tax, because your IRAs and those vehicles are included as part of your estate. They may not be in your trust, but they're included in your estate when we're talking about valuing the estate. So definitely a good strategy.
Yeah, and it's better for pull the money out, have grandma pay no income tax, and the beneficiaries inherit cash where they don't pay any income tax, versus the beneficiaries inherit part of the IRA. Now they're going to pay income tax
and be required to take money
at the top bracket potentially, and be required to take money. So there's definitely a tax strategy even in those later years where you want to take advantage of those things. And that's one of those annual strategy things, short-term strategy, where you got to be on top of it every single year. Usually you want to touch base with us at the end of the year to see how much we can pull out of the IRA or the 401k to not have tax consequence. Because if you missed the boat on that, you lost an opportunity for that year, like if you had negative taxable income or something.
Exactly.
So clients, when they have a death of a loved one, they often approach us as one of the first people, along with the estate attorney. You describe our process that we go through with them, what materials we have available to them, how we help in the administrative process for the trust or the estate?
Sure. A lot of times what happens is, like you said, they'll call us. They may have seen the attorney or talked to an attorney. They may not. A lot of times we're usually the first people. Generally, we have a couple of things that we can give them. One, we have a pretty comprehensive estate checklist. And basically what that does is it gives a list. It's all-encompassing, so some things are not applicable to every situation, but it gives the trustee or the executor the idea of the things that they should be considering that need to be done, the timing of when it needs to happen, and who possibly could be responsible. Is it us? Is it them? Is it the attorney? Those kinds of things. Then we have an asset inventory sheet that we give to them to kind of help them gather all of the assets in one place, because it's important to know where are these, accounts located, who are the beneficiaries, who owns it, are there, what are the values, all of those things, and we need to compile that when we're talking about estate or even just doing an income tax for the trust. So having all of those things are important. The other thing that we do is generally is when I'm meeting with a client, I usually get the name of the attorney that they're going to work with, and I try and reach out to the attorney and chat with them about, hey, we have this mutual client, kind of getting an idea of what the attorney's involvement is, where things are at, what their philosophies are, and what they plan on doing, basically, and who's going to do what. A lot of the times attorneys might prepare 706s, but a lot of times
706
is an estate tax form. So sometimes they'll prepare it, sometimes we will. So we have to kind of get on the same page as far as that's concerned. If they have not met with the attorney, a lot of times, and I have the trust document and I'm able to read through it, I can provide them with questions. I've done that and give them questions on, okay, how are we addressing A, B, C, D? So that way they come more prepared. All of this is new usually to somebody. People don't tend to be executors or trustees more than once or twice in their lifetime, right? So all of the language and the documentation and what is needed is new to them. And so the more guidance we can give them up front and the more they hear the repetition of what needs to happen, the more they can understand and they can do their job better.
Yeah, and they may have liability from being the executor.
There is definitely
also,
liability.
So they want to cross all their T's and dot their I's.
Absolutely. Having a fiduciary responsibility is an important thing. It means you have a legal right to do what's best for that trust legal obligation to do what's best for the trust and estate and the beneficiaries, which, can be difficult at times because sometimes the trustee, and actually a lot of times the trustee or the executor is also a beneficiary. And so making sure that everything is, like you said, all I's are, dotted and all T's are crossed is important.
Right. And you want to do what's right and what's correct. You
of course.
Follow the wishes of the decedent.
That's correct.
And
right.
What they wanted. So.
Well, generally, if were appointed the executor or the trustee, that person had trust in you that you were going to follow their wishes. And, when it comes to the trust document, that's quote unquote the Bible, basically. That's what you follow. That's whatever it says is what needs to happen. Right. It's very difficult to do something other than that. It usually requires some sort of legal action.
Mm-hmm. And that covers most of the questions I think we had on the basic, estate and trust process and everything else. Is there anything else you want to add on things people should be thinking about or, when they should be contacting you or anybody, their accountant at the firm here?
Well, anytime you have a situation where you're going to make a decision, like you said on gifting, should I give this now or later? Should I, sell this asset, not just from an income tax point of view, but from an estate point of view? Should I do this? Any kind of financial transaction like that is going to have an impact on your estate and your income tax return, right? So there's all kinds of things that you need to think about. If you have a parent who is, in this situation and where they're getting older and they're needing more and more help, it doesn't hurt to call us and talk to us about what's needed, what's going to happen. What are my concerns? What are we going to need to worry about? What should I get? Being proactive. What should I look for and what should I gather now? You talked about having, medical care, right? People tend to go into assisted living and then sometimes, as things progress, their care needs to be a little bit more. Talking about what's deductible, how much of that monthly fee is now deductible versus just a percentage, those kinds of things. So when you have situations where health is changing, beneficiaries are changing, life events, those are the types of things where you want to contact us so that we can help you make sure that your estate and your income tax situation is set up properly.
Yeah, so reach out to your accountant here at the firm if you have any questions about your situation. Don't be shy. That's what we're here for. We're here to help. And I tell a lot of clients that the estate and gift tax stuff can be like the biggest dollar tax saving things that we could do for you. We look at your overall lifetime of tax. People just tend to look at it in terms of every year, just this current year's income taxes. But some of these decisions impact a much larger dollar amount on your overall net worth and estate over your entire lifespan of being a taxpayer.
Not just yours, it's your beneficiaries too.
And your beneficiaries.
Mm-hmm.
So you really want to make sure you're contacting us. Reach out to us. If you're not a client, we have an Ask Wheeler section on the website where you can click on and submit some questions to us and schedule a consultation with one of our accountants. But these are the kind of things you definitely want to be asking us about. We have a lot of experience in dealing with this. We have several thousand clients. We've gone through these things many, many times, and this is where we can provide a lot of value.
Right.
Well, that's all for today's episode of the Debit This, Credit That podcast. As always, if you have any questions, you can contact your Wheeler Accountants Preparer, or you can submit a question online on our website in the Ask Wheeler section at the bottom of the page. Please remember to follow us on social media for regular updates, at Wheeler CPAs, and also on LinkedIn and Facebook. Thanks for listening as we help you solve for accounting.